Welcome to This Explainer. Okay, today we are diving deep into Sun Life Financial's Q1 2026 performance. Now, if you've ever tried digging through a major insurer's quarterly filings, you already know they can be, well, incredibly dense, usually packed to the brim with complex actuarial math and regulatory disclosures. Our goal right now is to transform those dense financial reports into a clear, structured investment case using the company's own data. We're going to separate the short-term noise from the long-term fundamentals to see exactly how this financial giant is positioning itself for the future. So, here's our game plan for today. We'll start with their global scale and strategy, then look at the actual Q1 2026 financial results. After that, we'll cover asset management growth, their expansion in Asia, and wrap it all up with risks and sustainability.
All right, Part 1. Global Scale and Strategy, Grounding the Business. $1.58 trillion. Yeah, that's trillion with a T. That massive number represents Sun Life's total assets under management as of Q1 2026. This isn't just some giant pool of money sitting around. This is the financial backing for a staggering network of over 85 million clients worldwide, and they're supported by more than 68,000 employees and over 99,000 advisors globally. This sheer level of scale, it creates an absolute fortress of a competitive moat and gives them some serious operational leverage.
And you know, Sun Life isn't just playing in North America anymore. They are operating across 28 distinct markets. So sure, while you've got these really heavy, established concentrations in Canada and the US, they also have a highly strategic presence over in Europe, mostly through their asset management arms. Plus, they are rapidly expanding into these fast-growing, strategic pockets all across Asia. This kind of global footprint is an absolutely crucial piece of their whole risk management puzzle.
But it's not just about where they operate, it's how they operate. Instead of putting all their eggs in one basket, Sun Life runs a really well-balanced business model. We're talking 41% of their business in asset management and wealth, 33% in individual protection, and 26% in group health and protection. This trifecta is huge because it helps insulate them against isolated regional or sectoral downturns. Think about it. If insurance claims suddenly spike, the asset management side can step up and provide stability, and vice versa.
Moving on to Part 2. Q1 2026 financial results beyond the headline numbers. Okay, you have to see this stark contrast. On one side, we've got a very strong underlying earnings per share of $1.89. But on the other side, the officially reported IFRS earnings per share is literally less than half that, sitting at just 84 cents. Honestly, if you were just skimming the headlines and saw that 84-cent reported EPS, you might think the company had a totally disastrous quarter. To really understand their true operational health, we need to dig into what's bridging that massive gap. So here's the breakdown. The core business actually generated a rock-solid underlying net income of over $1 billion, $1,050 million to be exact. But because of accounting rules, they have to immediately recognize short-term market fluctuations. So that underlying strength got dragged all the way down to a reported $465 million by non-core and market-related impacts. We're looking at a $120 million paper hit from interest rates, $53 million from equity markets, and a $47 million hit from real estate valuation changes. On top of that, they spent $183 million on acquisition, integration, and restructuring. The takeaway here? These are mostly transitional or market-driven accounting impacts, definitely not a fundamental breakdown of their core day-to-day operations.
Now, if we zoom out a bit, it gives us some incredible context. Looking at their underlying EPS versus the analyst consensus estimates over the past decade, wow. What this reveals is a super consistent track record of underlying earnings reliably matching or even exceeding consensus estimates quarter after quarter, year after year. It really proves management's ability to consistently execute their game plan and deliver high-quality earnings, totally brushing off that short-term market noise.
All right, Part 3. Asset management growth, the twin pillars.
So, Sun Life uses what we can call a dual-engine strategy for asset management, leaning on two very distinct brands. First, you have MFS Investment Management, which leans heavily into traditional public equities and fixed income for both retail and institutional clients. Then, on the flip side, you have SLC Management. Now, SLC is laser-focused on institutional alternative assets and yield-oriented investments. To put this into perspective, MFS is the absolute giant in the room, managing a massive $622 billion, mostly in public equities, and they boast a top quartile active management platform. Meanwhile, SLC manages $189 billion, but SLC's real magic is in alternative diversification. They are heavily invested in real estate, investment-grade credit, and infrastructure.
This is such a smart play because it perfectly captures the global trend of institutional investors hunting for higher yields through alternative asset classes. Basically, it gives Sun Life two totally distinct avenues to capture global wealth.
Let's pivot to Part 4, Expansion in Asia, a regional leader in fast-growing markets. Right now, Sun Life is operating across 8 distinct Asian markets, serving over 30 million clients. And let me be clear, this region is definitely not in some sort of startup phase for them. It generated a massive $775 million in underlying net income in FY25 alone. They are holding down incredibly strong, top-tier market share positions over there. For example, they're literally #1 in total premiums in the Philippines, and they hold dominant positions in mutual funds and bancassurance, which, by the way, are basically bank insurance partnerships across major markets like Hong Kong, India, and Malaysia. What's really fascinating is how they're scaling these Asian markets. Sun Life is honestly operating more like a tech company than a traditional insurer right now. To handle the massive volume of new clients coming in, they're digitizing aggressively. In Hong Kong, they've integrated data-driven, straight-through underwriting so they can instantly onboard clients. And in Malaysia, they've deployed AI-assisted talk bots for instant client engagement. They're essentially using cutting-edge tech to rapidly ramp up capacity without having to proportionally balloon their headcount. It's a really smart efficiency play. Finally, we arrive at Part 5, Risks and Sustainability, Navigating Volatility. Okay, treating this data neutrally, almost like a stress test, their filings give us the exact mathematical sensitivities, and it's pretty eye-opening. If interest rates increase by just 50 basis points, Sun Life projects a $25 million hit to net income and a whopping $200 million hit to their contractual service margin, which is essentially their buffer of unearned future profits. Or if public equities drop by 25%, that strips $250 million directly away from their net income. So while their balanced business model definitely softens the blow, they are still fundamentally tethered to the health of global macroeconomic indicators. There's no escaping that. Furthermore, their filings explicitly highlight some severe vulnerabilities to broader risks. Beyond the usual market headaches of equity performance and inflation, they face inherent insurance risks. We're talking about unpredictable mortality or morbidity claims that could, frankly, spike at any given time. And finally, because they are transforming into this highly digital enterprise we just talked about, they're actively calling out operational risks. Specifically, they're dealing with the rising threat of cyber attacks and the incredibly complex challenge of integrating AI and securing data privacy across 28 totally different international regulatory environments. So weighing all of this, knowing the gap between their incredible underlying operational strength and digital growth in Asia versus their reported vulnerabilities to interest rates and equity drops, we arrive at the ultimate question. The big takeaway for anyone reviewing this explainer is this: is Sun Life's diversified, multi-pillar model truly robust enough to weather the unpredictable global volatility ahead? The massive scale is there, the strategy is crystal clear, but those macroeconomic headwinds, they are absolutely undeniable. Thank you so much for joining me for this explainer, and as always, keep learning.